These are the things that you need to do in order to weather this coming recession. All right? Hey, soldiers, the American consumer is about to break. We've got 9 signs we're going to go over that you need to be very, very aware of, because it does look like, despite what the government says, despite what the media says, the facts on the ground say that this economy is slowing down. We're going to go over 9 reasons why that is, so you can be aware of what is really going on. You need to stay tuned for all 9. Now, we did this. Yes, this is not deja vu. We did this on a live stream, but the technology really didn't work out the way I wanted it to. It didn't have the high quality that I wanted it to. This is such an important issue that I'm doing it again outside the live environment. So let's get started. 9 signs that the consumer, the U.S. consumer, is about to break. When the U.S. consumer is in healthy financial shape, the outlook for the U.S. economy is generally positive. But just like we witnessed prior to the Great Recession of 2008 and 2009, when the U.S. consumer is not in healthy shape, well, bad things tend to happen. Look, the reality of it, guys, is households are running out of money. Okay, the working class, the middle class, are running out of money. Debt levels are soaring. Delinquency rates are up. Tens of millions of us are just barely scraping by from month to month. So this is not doom and gloom. This is proper positioning, okay? You cannot look on the horizon and see a storm cloud and then have somebody on your sailing vessel say, hey, looks like we're sailing into heavy weather here, and then indict that person, oh, you're just doom and gloom. No. This person is getting you ready for a storm, and so therefore you need to do some things, batten down the hatches, so that you will not fall victim to the absolute worst brunt of that storm. So the number one sign that Americans, the American consumer, is running out of money and is about to break. And when the consumer breaks, this economy breaks. After adjusting for inflation and taxes, household income in the United States has fallen 9.1% since April of 2020. All right, so this is a great way to frame this entire premise. Incomes are down. Americans just don't have as much money to spend, yet inflation persists. On the inflation issue, household income adjusted for inflation and taxes is running some 9.1% below where it was in April of 2020. Putting additional pressure on consumers. This is according to SMB Nikko Securities. Number 2, credit card debt has surpassed the $1 trillion mark for the first time ever in history, as struggling American households increasingly turn to credit cards to get by from month to month. We've done a lot of reporting on that, guys, and we even have a video that is giving you some tips on how to get out of that debt trap. Americans increasingly turn to their credit cards to make ends meet heading into the summer, sending aggregate balances over $1 trillion for the first time ever. This is according to the New York Fed. Total credit card indebtedness rose by $45 billion April through June, an increase of more than 4% that took the total amount owed to $1.03 trillion, the highest gross value in Fed data going back to 2003. And this is the highest level in history, okay? Number 3, the average rate of interest on credit card balances is over 20%, and that is crippling many American citizens. So if you can't get that balance paid in 30 days, whatever you purchased is liable to be at least 20% more expensive. So you're in a hole, you've got a shovel, and you're thinking you're digging your way out, but it's going from 5 feet to 6 feet to 7 feet, okay? And you're in the hole. You're getting in deeper and deeper is the way to think about that. Number 4, credit card delinquency rates are hitting levels we haven't seen in more than a decade. So more people are having trouble paying these balances. As the interest rate rises, so did that minimum monthly payment. And that's getting tough for people as they try to bridge that gap between income and inflation. The Fed's measure of credit card debt, 30 or more days late climbed to 7.2% in the second quarter of 2023, up from 6.5% in the first quarter, the highest rate since the first quarter of 2012. Though close to the long-run normal, central bank officials said total debt delinquency edged higher to 3.18% from 3%. So let's stop right here and let me ask you a question. When you come on and you see Biden and Kamala Harris and other administration officials crowing about Bidenomics and how good it's been, we're talking about data here, guys. This is not anecdotal. Does this jibe with what they're saying? Number 5, the number of Americans that are making emergency withdrawals from their 401k plans is absolutely surging. More Americans are tapping their 401k accounts because of financial distress. This is according to Bank of America data released Tuesday. Now, many 401k plans have what's called a hardship provision, but you just can't go in there and say, hey, I'm not able to, my season tickets at the NFL game, I can't hold on to them unless this is a real hardship for me. No, the hardship provisions are spelled out very clearly, all right, and they're narrow. So to the extent that people don't qualify for a hardship loan, that would save them from certain taxation and certain penalties that will be levied if you take 401k or traditional IRA money before age 59 and a half. You could be, again, exposing yourself to a 10% penalty, taxation at your current rate, and again, there's that shovel again, going further and further into the hole. So we're seeing a lot of Americans have to make that tough choice of saying, I got to draw down this money that I was saving for my retirement. It's going to hit me extra hard because I can't do it in a hardship loan. I got to do it outside that. My kid's tuition, got to pay that. I don't know if that is a hardship under the hardship guidelines. So more and more Americans are faced with that tough choice. They're running out of money anytime they got to go grab qualified money from that 401k. Number 6, over the past year, it has become much more expensive to purchase a home. Absolutely. Elevated mortgage rates and sales prices mean owning a home is about 20% more expensive than it was last year. This knocks a lot of people out of the box called affordability. Now, I know a lot of people say, well, look, Tyrone, you've got the interest rate that has gone up. Why are home prices still going up? There's supposed to be an inverse relationship there? Well, here's the problem. In a lot of these areas, you see a tight supply of housing. And, of course, we know the law of supply and demand. When you don't have a huge supply, but you still have some demand out there, demand that eclipses the existing supply, then that pushes prices northward. So that's what's happening there. Number 7, nationwide average rent-to-income ratio has been over 30% for the past 2 years. This is the first time in U.S. history that has ever happened. So people are being faced with taking a whole close to 1/3 of their income to rent. Now, you might say, well, Tyrone, are you going to break out your shovel analogy for this one? Yes, I am. And the reason for that is because you have to have a place to live, right? But when you rent, you do not build equity of any kind. This is why I will never understand this argument where people make, oh, buying a home, that's that American dream crap. Listen, at some point, you will begin to have positive equity in a home. You will never do that in a rental situation. If I buy a home at a 30-year fixed mortgage rate or 15-year fixed, I don't prefer a 15. I prefer the flexibility of the 30. But if I do that, then that means I have a stabilized payment. Rent usually goes up every year. So it's 30% now. What might we be looking at next year in terms of the income to rent ratio? People who rent are in a hard place because we just told you how home affordability is out of reach for more and more people. Number 8, it is being reported that vehicle repair costs have gone up by almost 20% over the past year. So you don't want to buy that new car because you're like, wow, cars are expensive. Even the pre-owned vehicles, they're prohibitively expensive. And I don't want to get into a situation where I got a $700 or more payment, which is the average out there in America today. Don't want that. Don't want the insurance that comes with that. But keeping my car on the road, it's more expensive still. Car repair costs are up almost 20% in the past year, according to the Consumer Price Index, more than 6 times the national inflation rate. So what's driving up prices? It's a combination of factors, experts said. Some emerged in the pandemic era, while others are longer-term trends in the auto market. All right, number 9, here we go. A whopping 69% of all U.S. consumers that live in urban areas are currently living paycheck to paycheck. So we got 69% of consumers in urban areas living paycheck to paycheck, which is 25% more than their suburban counterparts, 55% of whom live paycheck to paycheck. Additionally, 63% of rural consumers are reported living paycheck to paycheck. So on average, we've got at least 60% of Americans who are just trying to make it that 1 week stretch or that 2 week stretch over to the next paycheck, really putting a crimp in their ability to purchase assets. What can we do? Well, for starters, we need to look and listen to me carefully here, because this is what we really need to change our mindsets about. Get with friends, family. You may not be the type of person that's able to live with your family. I got some family members that I would not live with, okay? So I know you're probably the same. But I do, those same family members are people that I can get with and say, look, let's create a communal shopping list here, okay? And let's get to one of these warehouse stores like Costco, pool our resources to the extent that we can on certain necessities, like food, okay? Like toiletries, okay? Do the math. Figure it out for you and your family. Now, to the extent that you can, I know a lot of people who have children who recently graduated college or are in college, and they're still living at home. And that's not a bad idea, okay? We got into this consumer mindset driven by Wall Street and, others that said, no, you got to get out of the house, go start your life, buy a car, buy a house, get in debt as soon as you can, and stay there for the remainder of your life. No. If you get along with your kids, all right, keep them home. Sure, they got to pay something toward the household bills, but this is better for everyone, right? If the kids can stay there and start to build themselves up, there's no shame in it. All right, I always cite that TV show Dallas, where you had a bunch of rich oil barons, 3 generations worth, living in the same house. All right, so that was acceptable to put on television and have a hit show back in the 80s. Now we're here. So we need to take a step back and figure out how we can put our resources together as friends and family to weather this and eke out enough money to still purchase assets. Because in a recession, a lot of assets become, I'm not going to say cheap, but less expensive than they were beforehand. So think about it, guys. All right. And to the extent that you can cut expenses, you've got to start cutting expenses. These are the things that you need to do in order to weather this coming recession. Okay, guys, watch this video. Banks are in big trouble. We got 10 banks that were recently downgraded. It's important you watch this because you may bank with one of these institutions and you need to know what's happening. Guys, I'll talk to you soon.